The $35 billion asset mine. Intesa Sanpaolo just launched an unsolicited $35 billion bid for the world's oldest bank. But this is not about buying historical real estate. By targeting Monte dei Paschi di Siena in June 2026, CEO Carlo Messina is executing a massive asset strip mine to fuel his icy tech engine. This move effectively consolidates nearly €2 trillion in customer financial assets into a single digital silo, where the high-touch human model is being systematically replaced. It is a desperate land grab for scale in a Eurozone where interest rate spreads are no longer enough to hide operational inefficiencies. This consolidation marks the end of the regional bank as we know it, trading Italian history for sheer volume and algorithm-driven fee income. The Opex liquidation play. The press releases mention synergies, but the Q1 2026 earnings report reveals a much colder reality regarding the P&L. Intesa's cost-to-income ratio is already at a record low of 36%, and the only way to squeeze more juice is to eliminate the middle office. Their 2026 to 2029 business plan explicitly targets a headcount reduction of 600 people by the end of the cycle. By forcing the MPS client base into the Easy Bank and Fideuram Direct platforms, they are turning a labor-intensive relationship business into a low-OPEX software utility. They aren't expanding their service, they are liquidating the human labor required to provide it. This isn't about providing better advice. It is about automating the €16 billion profit target into existence by removing the banker from the wealth management equation. The rise of the meganode. European banking is consolidating into what I call meganodes, and Intesa is the prototype. By integrating BlackRock's Aladdin platform directly into their core, they have built a wealth management machine that doesn't need a local branch manager's intuition. In the current June 2026 landscape, scale is the only defense against the total commoditization of money. Smaller competitors like Banco BPM simply cannot match the R&D spend required to maintain an AI-native stack. Intesa's deal with Unipol to carve out 635 MPS branches proves the point. They want the assets, but they are literally paying someone else to take the physical buildings and the legacy staff off their hands. The meganode thrives on data density, not territorial presence. The signal under the noise. The real takeaway from this $35 billion consolidation is the admission that the traditional banking relationship is a dead asset class. Intesa is pivoting from a service provider to a data processing utility, and the MPS acquisition is the final piece of that transition. By combining wealth tech with massive asset pools, they are creating a platform where the cost of managing the next €1 billion is virtually zero. This shifts the competitive landscape entirely. If you aren't a mega node by 2027, you are just a takeover target for one. For operators, the metric to watch isn't the total assets under management, but the advisor attrition rates. If Intesa can retain the assets while the human advisors leave, the margin expansion will be historic. Watch the September extraordinary shareholders meeting for the final integration timeline. That is when we will see if the market actually buys the tech utility narrative or fears the execution risk of such a massive cultural wipeout. Subscribe for more.